Today we will discuss our chapter 4. The chapter 4 is capital structure and cost of capital, portfolio theory and the CPFA method, that means capital as a pricing model, market efficiency, capital gearing, and capital structure theory, portfolio theory. The portfolio theory is about finding the balance between maximizing your return and minimizing your risks. It is another subject, portfolio theory. So if you want to invest in your capital market, you have to manage the portfolio, because if you put all of your money within a few stock or share, and that share maybe sometimes is go for that means value is less or market collapse, then you will get a big trouble. So that's why in Bangla we can say that সমস্ত ডিমগুলি আমরা একটা ঝুড়িতে যেন না রাখি এবং আলাদা আলাদা করে রাখা, অথবা ঝুড়িতে একই জিনিস যেন না থাকে। সো এটা ওইভাবে ম্যানেজ করাই হলো পোর্টফোলিও, and that's why mutual fund is working with the capital market. Though we have no vibrant mutual fund, and in other countries mutual fund is doing the business through the portfolio management, and within the mutual fund they are all investing with the capital market, all instrument. They are taking different types of instrument within the mutual fund. So portfolio theory is about finding the balance between maximizing the return and minimizing the risks, and that means through minimizing risks and our return would be high. The objective is to select your investment in such a way as to diversify your risks while not reducing your expected return. It is actually simple to apply and effective, while it does not replace the role of an informed investors. It can provide a powerful tool to complete an actually managed portfolio. So modern portfolio theory or mean variance analysis. So here I think we do not need for very hardly to see the portfolio theory. Just for theory purpose, it can be a short note, describe the portfolio theory, 5 marks or 6 marks, etc. And capital market line, efficient frontier, also you will see in here, and CPFA here. So here, capital asset pricing model, how it come here. So we know total equity risks. The risk is unsystematic and systematic. Systematic risks, market risks. Unsystematic risks that we can control, and systematic risks we cannot control. So unsystematic risks within the company's risks, that means company's risks, industry risks. That means if you do not want to stay within this industry, or you can shift your industry, if you shift your sector, this is the unsystematic. And systematic, that means it should be within the that is built in. So unsystematic risks are specific to farm or industry, and it can be diversified. That means it can be shifted. It's have no compensation. But systematic risks market-wide affect all farm. For example, where recession, COVID at this moment, inflation, etc. Non-diversifiable. We cannot shift it, and the systematic risks. Investor compensates, and meanwhile in the beta. So that's why systematic risks, and using the formula beta. So here, this beta is the systematic risks. So market efficiency we say here. So representative buyer, market represents seller. So In middle times, we have to put an equilibrium side. This is the market efficiency. A buyer, a seller, and a market, how they work. That means all are depend with demand and supply. And market efficiency is the degree to which a stock price reflect all available relevant information, measures of the availability to all participation in a market of the information that provides maximum opportunities to buyers and sellers to effect transactions with minimum transaction cost. As a professional, you are the company secretary. You have to remember the cost of capital is the minimum required rate of return which company must earn on its fund in order to satisfy the expected of their supplier of fund. And concept of cost of capital has a role to play in capital budgeting as well as in the finalize the capital structure of a company. And cost of capital may be defined in terms of split cost which the firm places as supplier and implied cost, opportunity cost. And different source of fund available to the company may be grouped into debt, preference, share capital, equity capital, etc. So all have the cost, etc. Now here a problem here. Whatever we will calculate weighted average cost of capital, cost of equity, and weighted marginal cost of capital. So look here, weighted and cost of equity. A company has total asset 100 million and debt 20 million. The company's before tax cost of debt is 12%. Its cost of financing with equity is 15%. The company has a corporate tax rate is 40%. So, what is the company's weighted average cost of capital? So, in this side, we will calculate cost of capital. Look here, this one, number 1. So, this is the weighted average cost of capital. Debt divided by debt plus equity. So, debt is 20 million. And debt plus equity is, that is total asset is 100 million. Cost of debt is 12%. And within the cost of debt, we will adjust 1 minus TT mean tax rate 40%. Then we have to add the equity portion. That means if 20 is debt, then equity is 18 because debt and equity is 100. So debt plus equity is 100. And equity is 80, also million, multiplied by 15% cost of equity. So though all are million, then not mentioning here, just putting the figure. So here comes 1 point, that means 13.44%. So weighted average cost of capital is 13.44%. We will do this one. Weighted average cost of capital and weighted marginal cost of capital. Here 2 items. One is the capital structure after tax cost. That means after tax cost, they adjust each one. For example, debt, this 7% is the after tax cost. That means tax adjust after tax adjustment, this figure comes. So debt for like 50,000 is 7%. Preference capital 3,75,000 is the after tax cost of 10%. Equity 6,75,000 is 15% cost of equity. Calculate weighted average cost of capital using book value rate. So there are 2 formula also. One is book value, another is market value. So here in this problem there is no market value is mentioning here. So if we do the weighted average cost of capital, that must be book value because this is the book value. There is no market values here. And sometimes if it gives the market value, then you can calculate 2 ways. So here book value weighted average cost of capital number 1. If we go, this one is weighted average cost of capital. Okay, so source of fund, debt amount 4,50,000. Here preference capital 375, equity capital 6, total 15 lakh is total capital. Here debt, preference and equity. So if it calculate, if think that it is the 100%, then 6,75,000 is the 45,000, or also you can say it's 1, then it can be 0.45. So here 3,75,000 is the 25%. 4,50,000 is a 30%. So 30%, 25%, 45% equal to 100%. So it's the proportion. So with this proportion of source of fund, each and every, we have to multiply with the after tax cost. Here 30% multiplied by 7% is come 2.10%. So this way, after calculating 3 items, debt, preference and equity, we will get 11.13%. This 11.35% is weighted average cost of capital for this one. Now, here another portion. If we wish to raise further, that means is the condition 1, and another further 6 lakh. The expansion of the project. So here debt 3 lakh, preference 1,50,000, equity 1,50,000, and say that no change of cost of capital and other thing. So calculate the weighted marginal cost of capital. Why it is called marginal? It is the separate, fully separate from this weighted average cost of capital. This 6 lakh, that means marginally. Where we are we study in our statistics, so any consumer get last item, this is the marginal satisfaction comes from the last item consumption. So here it is the last one, that means it's fully separate from the previous one. This is the cost of marginal weighted average cost of capital, marginal weighted of cost of capital only for these 6 lakhs. It is the marginally have to calculate it. So come here the same way we are putting here. The structure is changed. Debt, preference, equity. Here total 6 lakh required for the investment, and if 6 lakh you can put 1, then equity capital is 0.25, preference 0.25, and debt is 3 lakh. It means that it's 0.5 or 50%. So with this figure, if we multiply the after tax cost, that means rate of cost, then we will get this way 3 weighted cost. This weighted cost, if we add, we will get 9.75%. So is the weighted marginal cost of capital. Very simple as per the weighted average cost of capital. Just is calculated the marginally. That means last one. So it's okay. And then another problem. So we have some another problems here. Weighted average cost of capital, and solution also here. It's very small. Question is big, but answer is small. Look here, very easy. So I think you do it in yourself. Now what is beta? Beta is the measure of the volatility of systematic risks, and we are using beta within the CFM formula, and beta primarily used in the capital asset pricing model. Beta data about the individual stock can only provide the investor with the approximate and beta. How beta calculate? Beta calculation is here. It is the statistical formula, a covariance, and then calculate. We do not need to calculate the beta, because if we get the in our exam, we will get the beta value of the beta. We will get it. So here some different types of beta we have. Beta value equal to 1. It's beta value less than 1, beta value greater than 1, and negative beta value. all have the corresponding response here. If a stock has a beta 1, it indicates that its price actively in strongly correlated with the market. This is the correlation. That means actively correlated with the market. A stock with a beta 1 has systematic risks. However, the beta calculation can't detect any unsystematic risks. A beta value that is less than 1 means the security of theoretically less volatile than the market, etc. So I think it is not harder. So beta coefficient is also look here. This is the beta coefficient here. 1 means is the middle side, beta 2 is upper one, beta 0.5 and 1 and upper the 0. Finance, we have different types of risks. In finance, there are 2 types. One is systematic risks and another in unsystematic risks. The systematic risk is uncontrollable by an organization, and unsystematic risks controllable within the organization. So systematic risks, interest rate risks, that you can control the interest rate, and within the interest rate is depend price risks and reinvestment rate risks, and market risks, absolute risks, relative risks, directive risks, non-directional risks, basic risks, volatility risks, etc. is the market risks. And purchasing power on inflation risks, demand inflation risks, and cost inflation risks. And unsystematic risks that we can control, business risks, liquidity risks, asset liquidity risks, funding liquidity risks, and financial risks or credit risks, explorer rate risks, recovery rate risks, credit event risks, subversion risks, and settlement risks. And operational risks, that model risks, people risks, legal, etc. So here, systematic risks, we cannot control it, we cannot reduce it, we cannot diversify it. So its example, inflation, recession. Unsystematic risks, we can avoid it, we can divert it, we can reduce it. For example, labor strike, we can manage it, managerial change, we can manage it. So CFM is here, beta. And now capital gearing. So capital gearing is the degree to which a company acquire asset or to which the fund is ongoing operation with long and short-term debt. Capital gearing will differ between companies and industry and will often change over time. Capital gearing, also known as financial leverage. So this is the capital gearing, that means debt equity percentage. So here, look here, capital gearing is a British term, but USA is called financial leverage. So financial leverage is the term of US, United States, and capital gearing is a term of British term. Both are the same. So here, why to manage gearing? Why we have to manage gearing? A business with a gearing ratio of more than 50% is traditionally said to be the highly geared. Leverage is also operating leverage and financing leverage. The importance of operating leverage. Here we are going for a math. Combined leverage. This is the formula here. General income statement format, types of leverage. Look here, left side, operating leverage and financing leverage, and right side, total leverage. Total leverage means operating leverage plus financing leverage. So here, operating leverage can calculate sale revenue, that we have to minus cost of goods sold, then we will get gross profit. and from the gross profit we have to deduct operating expenses. Then we'll get earnings before interest and tax. So this portion is operating levers, how operationally increase the value within the organization. And then financing levers. From the earning before interest tax, we have to deduct interest. Then we'll get, this interest means debt interest. We'll get net profit before tax, and if we less the tax, then we'll get net profit after tax. And from that we have to pay the preference stock dividend. Then we'll get earnings available for the common shareholder. Then we have to divide this common shareholders earning by number of the ordinary share. Then we'll get earnings per share. So this portion is financial levers. So here a few question is here, and also solution is here. This question now, okay, equity finance solution 23. Okay, number one, look here. The total leverage effect. One company expected to sell 20,000 units at the rate of $5 per unit in the coming year, and must meet the following obligations. That means variable operating cost $2, fixed operating cost 10,000, interest 20,000, preference dividend 12,000 under the 40% tax, common share outstanding 5,000. So here, as a company secretary, show the total leverage effect of considering 50% expected sale increase. So if sale increase from here 50% more, then what would be the leverage effect? So within this figure, if we calculate here, this one, look here. So total leverage effect, where sale in unit 20,000 as per the question, and saying that if increase 50%, look here, 50% increase, so total sale would then 30,000 unit. So what would be the sale revenue? In the level of 20,000 unit sale revenue would be $1 lakh, because per unit is $5. Selling price per unit is $5. So same way, $5 multiplied by 30,000, then we will get 1,50,000. It is the sale revenue. And from that, we have to deduct the variable operating cost. So what is the variable operating cost? Variable operating cost is per unit $2. So here $40 and here $60. And fixed operating cost, fixed for the both. We know the calculation of that is fixed cost and variable cost. Fixed cost always fixed, variable cost vary. So but it's another assumption, that means fixed cost always fixed for in the total, but it is variable in the for the unit, because if you produce more, then per unit fixed cost would be less than the other thing. So here we have to deduct the fixed cost 10,000 in the both way. So earning before interest and tax will get EBIT here 50,000 and here 80,000. So what we did, from the 1 lakh we minus 40,000 and 10,000, and from the 1,50,000 we minus 60 and 10,000. So it now 80,000, 50,000. So what is the difference between the figure? So it's mean that if our sale 20,000, then our earning before interest tax 50,000. If our sale unit is increased by 50% and that sale unit is 30,000, then our earning before interest tax increase 80%, 80,000. So what is the increase value? That means 50,000 and 80,000. So this increase in 60%. So increase 50% unit sale increasing by increasing 50% in the sale unit. Our earning before interest tax increase 60%. So it is the operating leverage. Also you can say here right side degree of operating leverage. So degree of operating leverage is equal to here 60% divided by 50%. It's mean 1.2. So it is the proportion was operating leverage. Now financial leverage. From that figure, that means 50,000 is earning before interest tax. We have to pay the tax. That means interest. So interest 20,000 for the both. Then we get net, if we minus 20,000 from the 50,000 and 20,000 from the 80,000, then we will get net profit before tax 30,000 and 60,000. And from that, 30,000 multiplied by 40%, that means tax 12,000 and 24,000. We will get net profit after tax 18,000 and 36,000. So net preference stock dividend have to minus from here. So earnings available for the common shareholder $6,000, and here in the level of 30,000 unit sale, here $24,000 earnings available for the general shareholder. So look here, this 6,000 if we divide by number of share 5,000, so earning per share would be $1.20. Same way from the 20,000 earning be available for the common shareholder, if we divide by number of share 5,000, because number of share is the same, outstanding share 5,000, so we'll get 4.80. So here EPS is 1.20, but here EPS is 4.80. So increase in EPS 300%. So 1.2%, then 4.8 is increased 300%. So look here, degree of financial leverage in here. So 100% increase divided by 60%, so get 0.50. It is degree of financial leverage, and multiply the both, or if you multiply, that means degree of total leverage, closing thing divided by opening. So 50 by increasing 50% sale, EPS increasing 300%. So here 300% divided by 50% is come 6. So degree of total leverage is 6. So here if we multiply both, DOL multiplied by DFL, that 1.2 multiplied by 5, that also would be the answer 6. So it is the total leverage effect. So what is saying here? Look here, the level of earnings per share associated with the expected sale unit and with the sale at the unit as a result of 50% increase in sale from 20,000 to 30,000 unit, the firm would experience a 300% increase in earning per share. That means it can be reverse also. What is the important? It helps to financial manager to design an optimum capital structure is the main thing. And operating leverage, it gives an idea about the impact of change in sale on a operating income of a firm. Just only changing the sale unit, what effect comes here? And also financial leverage, that means it helps to manager or investor to optimum capital structure, choose the optimum capital structure. So there are huge items here for the benefit. Also is the formula difference way. Here also the formula difference way. So with the chapter 4, another item, capital structure theory and decision is remaining. We'll discuss in next class. We discuss the cost of individual types of finance, risk return, weighted average, CAPM, market efficiency, capital gearing, etc. Only one item is remaining, capital structure theory and decision for this chapter. So we have seen here capital structure, component of capital structure, optimal capital structure, cost of capital, weighted average cost of capital, factors affect capital structure, risk return related to the cost of capital, weighted average cost of capital. Then we have seen the relationship between asset, capital structure and dividend. Then we calculate the cost of equity capital and difference format, that means CAPM model, bond yield plus premium approach, dividend growth model, earnings price ratio model, and this fourth item is within this one math. Also we calculate here. We have seen the few portfolio item and we seen the general idea of CAPM, also basic, and we calculate cost, weighted average cost of capital, weighted marginal cost of capital, etc. And we have seen a few beta item and also types of risks in finance, systematic risks, unsystematic risks, and we seen the capital gearing or financial leverage, and also here we solve a problem here, that means total calculation of total leverage effect. So it's all for today, sir.